You're listening to the Breakthrough Investor in Commercial Real Estate Podcast. Brought to you by MVP Equity Group, where we learn from private equity experts, their mindset, and ways to achieve financial independence. Here's your host, Ernest Peralta.
Breakthrough Investor listeners, welcome. I'm Ernest Peralta, and with us today we have Charles Seaman. How are you, Charles?
Ernest, I'm fantastic. Thanks so much for having me on the show.
Absolutely. Well, I'm looking forward to our conversation today.
As am I. Thank you.
Well, a little bit about Charles. He's a native of Brooklyn, New York, and currently resides in Charlotte, North Carolina. He serves as the managing member, senior acquisition manager, and asset manager of Three Oaks Management, where he actively works to locate high-performing multifamily real estate deals throughout the southeast region of the United States. He's responsible for performing all of the company's initial underwriting and analysis of these deals, which ultimately determines whether or not the deal will be a good fit for the company. He has currently 3 assets with about 240 units or so, and Charles also has 14 years of prior experience working for a commercial real estate investor in New York City. So with that being said, Charles, could you tell our listeners a little bit more about where did you start, where are you now, and how did you get there?
Absolutely. So where I first started, I really stumbled into commercial real estate by accident. I can't say there was any plan to get into it, but I'm glad that I did. And where my story started, I was 20 years old, and lack of a better term, I was young, dumb, and broke. And I needed a job that would pay the bills. I had a job as a bank teller. I wasn't making a big amount of money, and I needed to do something different because my mother became disabled. I wound up working for a guy who eventually oversee management of all of his different industries and different people and different lines of thinking. And I'm glad that I had that experience because it exposed me to many good contacts and it gave me different industries to really learn a lot about. And of those industries, while there's a lot of money in construction, I also realized it's a lot of stress. So while there is stress in real estate, I'd rather deal with the stress that real estate brings. Mm-hmm. So I always gravitated towards that side. And around 2014 or 15, I'd been at my job by that point for about 9 or 10 years. And I knew that when I first started there, my intent was never to stay there forever and ever. And I was really planning to stay there 2 to 3 years. But sometimes as life happens, you get complacent and you get set in your ways. I started making a little more money. And I said, well, you know what? I probably forgot what my initial plan was. And after, a decade and then some, I wound up staying there for 14 years in total. I finally came to a point where I said, well, my goal was always to run my own investments and run my own businesses and go to a different level than I could ever be at by remaining an employee. So at that point, I was approaching 30 and I thought to myself, well, I'm not getting any younger. If I'm going to make a mistake, which hopefully not, but I'm sure there'll be some along the way. But it's better to make that mistake when you're younger, as opposed to when you're older and you have less time to catch up. So around 2014 or 15, I started delving into single family, and I quickly realized 2 things. One is that I just didn't like it as much. I was used to working on commercial deals at work. And to me, I just felt it as a kick right between the uprights to go back and start with single family. So, and the second thing was I wasn't as good at it. There was a lot of similarities between residential and commercial, but there's also a lot of differences. And being that I was used to working on the commercial side, my skill set was very sharp for the commercial side and not as sharp for the residential side. So after a few months of dabbling into it, I realized that it wasn't the right fit for me. And I took a step back. And then around 2016, I was exposed to syndication for the first time. And at that point, I thought about it and said, well, I can do this. I can use the skills and the talents that I have already. I can go out and do the types of deals that I want to do. And I can use other people's money to fund them. So it was really the best of both worlds. Because I knew that I had the talent and the skill set to acquire commercial real estate, but I also knew that I personally did not have the budget to go out there and buy commercial real estate. So syndication really provided an avenue for me to take the next step. And then little by little in 2017, I started working on it part-time. I was still at my job full time at that point, and I was working anywhere from 60 to 90 hours a week. And then I would put consistently 10 to 15 hours a week into syndication. Now, somebody out there listening may say, what good does 10 to 15 hours a week do? And the answer is, it does a lot better than zero. It doesn't do as good as 40 or 50 or 60 hours, but it's a lot better than nothing. So what I really disciplined myself to do during that period was to be consistent and not to accept any excuses. Some people might say, well, you work a lot, when do you find time for it? Well, you find time, cut down on sleep. So there's always ways around things. We have 24 hours in a day. So the key is to figure out how to use as many of them as possible and effectively. So start developing some discipline in yourself and then push yourself a little bit further, get consistent with this business. After about 2 years, then I got to the point where I left my full-time job, relocated to a different city because that was where we were focusing on the multifamily business, and really immersed myself in the business. So it takes time. It's not overnight. What I would tell anybody out there is that syndication is a great business. It's a very lucrative business, but it is definitely more of a marathon than a sprint.
You hit on some key points there. And one of them was early on in your career, considering that you did this all before you were 30 years old, you were able to capitalize on taking a step back and analyzing your background and skill sets. And what are some of the transferable skills that you learned from single family over to commercial real estate? If you don't mind just highlighting a couple of those.
The biggest one that's really benefited me is relationships and dealing with people. And in essence, that's really true for any business, and especially something like real estate, which is very much a relationship business. Now, with single family, one of the main differences is that it's really more transactional than relationship based. If you're doing a good job with single family, there's a good chance that you'll probably build some relationships along the way. But commercial is almost all relationships. I can honestly say that I haven't gotten a single deal on the commercial side without relationships. And I probably never will get a single deal on the commercial side without relationships. They are through good broker relationships, good sponsor relationships. And that's a skill that I would advocate anybody listening to go out there and develop, because if you want to be successful in real estate, whether it's through syndication or anything else, you need to learn how to effectively deal with people and how to be able to get the most out of them while also giving them something in return.
But you've always got to continue building those relationships. And that's basically how it works.
Right. And another skill that was always transferable is just operational efficiency. Mm-hmm. So one thing I learned with the role that I was in at my full-time job was how to juggle a lot of my plate, how to prioritize things, and how to ensure that we're getting the best result that we can. So that's something you can use in syndication for multifamily investing as well. With multifamily, another key difference between that and single family is that really every property is its own business, and you need to have the right team in place to be able to run the property. It's a bigger operation than what one person is going to be able to handle in most cases. So you'll usually need some help, and that could be in the form of a property manager. It could be in the form of partners. It could be in the form of both, but you'll need to have the right players on your team and figure out how to get the most out of them if you want your properties to run well.
And also just kind of writing on that topic as well, before you even start building your teams of folks, for this multifamily or commercial property that you're looking at, you want to be able to analyze it and to be able to really look at the deal a little closer to see if it is a valid deal to pursue. So, our topic here today, of course, is diving a little more deeper into the underwriting process. Would love to kind of, dive in and focus on this a little bit more. So, Charles, can you explain to the listeners what is underwriting?
Absolutely. So underwriting is analyzing the current and projected future financial performance of the property to determine whether or not you have a viable deal. So what you're doing is you're taking the seller's income and expenses, and most people do it through either some type of spreadsheet or other operating software tool, and you're plugging that in, and usually you'll see if those metrics deliver the return that you're looking for.
Perfect. Nice summary. Really, that was pretty succinct. So real quickly, folks, so if you stay until the very end of this podcast, we have a free gift that we would like to share with you. And we think that'll be very helpful for many of our listeners on this show. So stick around to the very end. All right. So Charles, can you walk us through basically how many deals do you have to underwrite for you to purchase just one property?
Years ago, it was probably 100 deals for every one that you find. But what I would say is, especially starting out right now, it's a lot more competitive. We're at a point in the cycle where it is definitely a strong seller's market, which means there's a lot of competition on the buying side. So for me personally, I can't say that I tracked it exactly. Now I do. But when I first started, it was somewhere between 150 and 200 deals. And there's a lot of deals that you wind up looking at. Truthfully, even the first deal that we did, I don't know that if I would have done it myself without having our sponsor involved, because his underwriting was a little bit different than mine. So mine may have been too conservative. You know, my thought process has always been I'd rather have conservative underwriting keep me out of a bad deal than aggressive underwriting get me into a bad deal. Mm-hmm. So, the thing is, you may lose more deals than you get with conservative underwriting, but it'll probably benefit you a lot more in the long run.
A lot of people that are trying to get into syndication try to rush getting into their first deal. But like you said, take your time, really analyze it.
Absolutely. So it's a lot faster to destroy a reputation than it is to build it. So always keep that in mind. Protect your reputation like it's gold.
Yeah. Good point. So if we look at underwriting just a little bit closer, there are 3 basic documents that you have to typically look at. And these are the T12s, the trailing 12s, the rent roll, and the offering memorandum. Charles, do you mind just kind of going through each one of these documents and explaining what each of them mean and how you actually take it as far as the underwriting is concerned?
Absolutely. So the trailing 12, as I said, that's the last 12 months worth of income and expenses. So most times the broker or the seller is going to provide that to you, and you're going to plug that into your underwriting software. So usually on the income side, you want to look at that on a T3 annualized basis. So what that means is even though you're getting 12 months of information, you only want to account for the last 3 months, and then you annualize them, which means you're taking your total for those 3 months and multiplying it by 4. And that's going to give you the income numbers you want to use for the property. On the expense side, you're going to take it on the actual T12 basis that's on there. And the reason we do it that way is because that's oftentimes how agency lenders that are Fannie Mae and Freddie Mac lenders are going to look at it. So we always want to look at things the same way they will. So that way there's no surprise when we go submit our loan application. Then now the trailing 12 does a great job of providing the overall financial assessment of the property. But keep in mind, there's one key word in that name, and that's trailing. So it's past performance. Just like in the stock market, we should also add a disclaimer here. Past performance is not indicative of future results, but there is also a good probability that it's going to provide some insight into it. So the rent roll, what that is that's the most current snapshot of the income performance at the property. You won't really get any information on the expenses from that, but it's a detailed list of all the tenants that occupy units at the property. It'll typically give you the tenant's name, the amount of rent they're paying. It'll show you what unit they're occupying, when their lease started, when their lease ends, and if they have any past due balance. So that's usually the information that you're looking for on the rent roll. And the way that I would usually use it as it pertains to underwriting, there's really 2 things that I zone in on. I like to see what the current rent is, because oftentimes that'll be an even more accurate picture than the T12, because the T12 is trailing, keep in mind, so rent roll is more current. And the second thing I look at is to see if it has any past due balance, because right now, especially in the pandemic times that we're in, it's very important because most properties do have past due balances. So you just want to understand how much is outstanding and what is the likelihood that any or all of that money is going to be collected at some point. And then for the OM, that stands for offering memorandum. So if you're looking at an on-market deal, which means it's a deal that a broker is circulating to their entire mailing list, they'll usually prepare an OM. And the OM, depending on the deal, can probably be anywhere from 40 pages on the short side to maybe 100 pages on the long side. And it's going to include pictures of the property, information about the property. It'll give you a high-level executive summary of why you should buy the deal. And then it'll include some information on the financial information of the property and any possible value aids you could use along with information on the area. So most times what I use the OM for is just to get information. And when I first underwrite a deal, my main purpose doing so isn't even to assess the viability, but it's to go back to the broker with questions. And my goal is that by the time I finish reviewing those materials, I want to have a list of questions that I can go back to the broker with and say, okay, I reviewed this deal. These are the questions I have. I need this information here to move forward.
Basically use that as more of a guideline. Don't take it, per se as the one all be all, because it's the T12 and the rent roll that you're actually gathering more of the more concrete information for the property itself.
Yep. Keep in mind, the broker's job is to sell the deal. And I don't say that negatively because, eventually as we buy properties, we'll want brokers to sell them for us. So it's just the nature of the business. So in order to sell some things, sometimes you may have to embellish a little bit. So it's not to say that the information there is not truthful, but it may be indicative of a best case scenario, which unfortunately we don't always get best case scenarios in real life.
Right. Yep. Good point. So real quick, you mentioned about the pandemic. There was a lot of activity that was going on in your neck of the woods. And I would love to talk briefly about that deal that you closed during the whole pandemic crisis. I believe it was a 48 unit in Sumter, North Carolina. Could you tell us a little bit more about that deal?
Yep. So it's actually Sumter, South Carolina, but yes, it's a 48 unit deal. So we started looking at the property in late January, 2020. And this was another deal that came from broker relationships. So I'm going to emphasize the importance of building those. And we were having lunch with the broker and he asked us, what are your thoughts on Sumter? And my first thoughts were, well, where is Sumter? I don't know. He sent over the financials. We looked at it and I said, you know what? It makes sense. So from a financial perspective, it looked good. My biggest concern was that we'd be investing in a market that didn't have too much going on. So before we really did anything with it, we wanted to go tour the property and we wanted to drive the market to really feel confident in it. So what we did is we toured the property, and I live in Charlotte, North Carolina. So Sumter's about 2 hours away from there. So probably about an hour and a half of the drive was on back roads in areas with limited cell phone service. So our initial thought was, boy, this really is going to be in the middle of nowhere. And then as we get closer to the property, about 10 to 15 minutes away from it, it actually starts opening up and we see a nice little bustling city. For a smaller tertiary market, it's not New York or Los Angeles, but for a smaller tertiary market, it was a little thriving metropolis. So as we started driving closer and closer to the property, we see more traffic. We saw some major retailers. We saw some new development that was going on. So all of these things were encouraging. And we realized after driving the area that the property was located in what was probably one of the better sections of town. It seemed to be a good spot, with a lot of renter demand. And we instantly became confident that we could hit the numbers we showed in the underwriting. And then at that point, we decided to put the offer in and we worked out a deal. So fast forward a little bit, it was around February 13th or so, I think, when we signed the contract. So anybody who remembers, we may have heard some rumblings about the pandemic at that time, but nothing major just yet. Then about a month later, we're under contract. We're in our due diligence period. We'd already done our due diligence inspection. Then the next thing was, we were applying for bridge financing. Now, the reason is because this property was only 75% physically occupied. And after seeing the property and seeing how it was managed, we realized it was really more of a management issue than anything else. There was only two ways that they were marketing for tenants. And one of those ways was in the print version of the newspaper, which is not the most effective way to find tenants in 2020. We realized instantly by implementing fresh management that we'd be able to make some drastic changes at the property. And we said, okay, let's go forward. We'll have to get bridge financing because it's not stabilized. So right on the evening of St. Patrick's Day, our mortgage broker called me. And, for anybody who remembers, it was around March 11th where the pandemic really kicked into high gear. So many bridge lenders shut down their programs temporarily because there was so much uncertainty in the market around this time. So our mortgage broker calls me and he says, Charles, I have some bad news. The lender's temporarily suspending all lending. And I said, okay. So the good news is they were going to refund our loan application fee in full. So I said, that was good. At least we didn't take any loss on that. And it had nothing to do with us or with the deal, but just more so the overall market, and that there was so much fear and so much uncertainty that almost all bridge lenders suspended their programs. Fannie and Freddie were really the only ones providing liquidity, but they they really don't do a lot of bridge lending. We had some decision making to do at that point. I had to discuss with my partners and say, do we want to stay in this deal? Is it worth trying to work something out? Or do we just terminate the contract while we're still in the due diligence period and get our money back? We liked the deal. We really couldn't find anything bad to say about it. The larger concern was just financing in the overall market. So we decided that we wanted to pursue the deal, and we were able to work out an agreement with the seller, the due diligence period, by 60 days. Mm-hmm. Now, there really wasn't any extra inspection or any extra diligence that was needed, but it was more so just to see if the overall market would rebound and if some of these programs would start opening up again. Around late August, much to our surprise, the property became stabilized. And that can be good or bad, because the good side is, okay, well, it opens up new financing options, so that's a great thing. But the downside is they had 12 units that were vacant out of 48 in January, and I believe around the same in February. So how did we go from 12 vacant units to fully occupied by the end of April? So it almost makes you wonder, did they do a good job screening these tenants, or did they really just put anybody in there that's able to walk and sign their name to a lease? Mm-hmm. Thankfully, they've actually done a decent job because they're paying. So that's a good thing. But what happened is we were able to qualify for agency debt because of that. So initially, we submitted an application with the lender. This is around mid-May. We decided we're going to move forward with the deal. And on their term sheet, they had given us 75% LTV. They gave us a decent rate, decent terms, and it seemed to check out. So somewhere in June, they have their third-party inspections done. The appraiser comes out, and the property appraised for more than any of us really thought it would. So the box was checked, and we did good there. Then after that, they have the rest of their inspections. They're doing the rest of their underwriting. Everything's looking good as far as we know. All of a sudden, around mid-July, as they're nearing the completion of the process and getting ready to issue a commitment letter, tell us it's going to be 6. I said, we started with 7, more than any of us thought it would. Overall, we weren't aware of any. It's not going to work for us because that's going to kill our returns. So we decided not to have them issue the commitment. And then we went to submit a loan application with another lender, and we negotiated another extension with the seller, which cost us a few bucks. But thankfully, they could they could understand what happened, because it was the most unusual time during the peak of the pandemic last year. And they knew that if we terminated the contract and walked away, they would just have to start the process over again with somebody else. Mm-hmm. They were willing to work with us. We submit the new loan application. We explain the situation to them up front, because we don't want the exact same thing to happen again with them. And they felt pretty confident that they'd be able to make good on their terms. They're going through their process. They have to have a separate set of third-party inspections done. And they're expediting the underwriting as much as they can, but obviously it's still a lender, and there's things that they can't bypass. So finally, as we get to mid-September, they tell us that we're going to be approved and they'll be able to give us the terms that they offered. And I said, okay, well, that's refreshing, because we had a much different approach with a different lender a few months ago. So then we were able to set up a closing date. So I jokingly say it was probably the longest closing in history for a 48-unit deal. It took us probably about 7.5 months from start to finish, but we finally brought it across the finish line.
That's a big accomplishment in itself.
Right. And initially when we first got into the process, especially with the pandemic, I thought that we would have more trouble on the equity side than the debt side, but I was wrong. Mm-hmm. It was the debt side that took us for a whirlwind, while the equity actually came fairly easily.
I really appreciate the the background on that and the information on how you guys closed that 48-unit deal in South Carolina. So that was really good. What mistakes did you make as a new investor, and what did you learn from it?
The 4 big mistakes that I made starting out, and I tell people these because I think these are some of the more common mistakes. And depending on personality type, some people like learning the easy way, some like the hard way. I usually prefer the hard way. So one is that I didn't pick a target location. And these are all things that you hear people say, but sometimes until you make the mistake yourself, they don't fully resonate. So picking a target location is important because it gives you the advantage, 1, of knowing the area better, and 2, of building relationships there. If you're always looking at deals in different markets, you're always going to be the low man on the totem pole. So you're starting from scratch. Nobody knows who you are. You have no credibility, and you have to go there and build that. initially in my first year in the multifamily syndication side, I looked at deals, one in Ohio, one in Indiana, twice in Kentucky. One of my partners was in Tennessee. And after about a year, we said, you know what? We need to smarten up a little bit and pick a target market. So that's when we decided to settle on the Carolinas and really make that our focal point. And from there, things started picking up because we started building better relationships and we started becoming more familiar with the market. So we really got to hone in and see the advantage of doing that. Now, eventually, as you have some deals and you have a track record, you can definitely expand into other markets if that's the route you want to go. But starting out, it's really important to pick one market. Then second thing I would tell you is finding partners. So most syndication groups have anywhere between 2 and 4 partners. And the reason for that is probably twofold. One, the workload can be very overwhelming if you're doing it by yourself. There are 2 main roles in this business, finding deals and finding money. And if you're doing a good job at both, you're probably not going to have time to do both. So you'll need somebody to go in there and help. So I recommend to anybody, they should figure out what their strengths are. You know, we all have things that we're good at and things that they're not. And most people generally know, okay, I'm probably better on the acquisition side, or I'm better on the investor relations side. And what you want to do is find a partner or partners that can fill the gaps and fill those holes where you're not good at. So do what you're good at, use your strength, and find somebody else to use their strength to fill those holes that you're not good at. Third thing I would tell you is finding investors. And that may sound like common sense in syndication, but you'd be surprised how many investors and syndicators don't have investors until after they find a deal. And I think part of the reason for that is because with so many different real estate publications and podcasts out there, people say, if you find the deal, the money will come. Let me throw 2 caveats in there. So if you're out there buying a single family home or wholesaling a single family home, you may be able to get it for $100,000. It's a lot easier to find a person with $100,000 in cash laying around than it is with somebody that needs 2, 3, 4, 5 million for a commercial deal. So there's not as many of those laying around. The second thing I would tell you is that in the syndication business, what we're really doing is selling securities. So being that we're selling securities, there's different rules and regulations that apply. So in most cases, it is not legal to meet somebody to get a deal on the contract today and meet somebody tomorrow and say, okay, listen, would you like to invest in my deal? Now, I'm sure that it probably happens more than people care to talk about, but you can get yourself in a lot of trouble by doing that. So I would strongly advise against it. And that kind of goes back to finding partners as well. So the key is that you want to be looking for deals simultaneously while you're also looking for investors. And one of the common questions I think you'll hear people say is, well, what do I tell my investors when I don't have a deal? And it is a little bit tougher because you don't quite have that substance yet. But what you want to do is just engage them in conversation. You want to let them know that you're actively looking for deals. And you want to find ways to keep them aware that you're still in business and that you're active in the business. The last thing you want to do is meet an investor today, and then a year from today, when you finally get a deal, go back to the investor and say, hey, Mr. Investor, we met about a year ago. What do you think? Do you want to invest in this deal? The answer is almost definitely going to be no, because they're not really going to know you too well. So you want to find a way to stay top of mind and a way to be relevant. So that way, when you finally get that deal and you contact them, they say, oh yeah, I know that guy. I get his emails all the time. And something to stay relevant. So you can find content, even if initially you might be using content that's put out by other people, but eventually you want to get to the point where you're creating your own content and you have something that attracts people to you. Then the last thing I would tell you is building sponsor relationships. And a sponsor is just the person that signs on the loan. But if you do a good job building sponsor relationships, they can be a lot more than that. And they can let you use their track record, which is really the benefit. And probably of these 4 items is the single one that will help you build your business faster. This is very much a track record business. So initially, as you're starting out, you won't have a track record. It doesn't matter how successful you were in your previous walk of life. That does hold some weight. It's still not going to necessarily convince them that you'll be able to go out there and close a multi-million-dollar deal. we're all starting from scratch, regardless of what our previous track record was. So knowing that, the quickest way to be able to grow your business and scale is to use somebody else's track record until you have your own. And again, don't do this without asking the sponsor's permission. Make sure you get their permission. Otherwise, you'll probably lose their trust. But ask them and say, Mr. or Mrs. Sponsor, do you mind if I use your name when I speak to brokers and investors? And if they tell you yes, then do it. And when you speak to the broker, all of a sudden, if I go to them and say, hi, my name is Charles, I'm brand new and I'm looking for my first deal, what do you have? Or if I go to them and say, hey, Mr. Broker, I'm working with John Smith. John has 2,500 units. I'm his local boots on the ground in this market. What do you have? Use your imagination and figure out which one's going to get the better response. And I'll tell you this, the same thing also applies to investors. Nobody ever wants to be the investor that winds up being the guinea pig and saying, okay, let me be the first one to invest with this guy. Yep, I fully agree with you on that.
That's great. What is one of the number one habits that you use or that you've kind of followed for your success?
Not accepting no for an answer. You know, when you're tired and you don't want to do it and you can find 1,000 excuses, don't allow yourself to quit. Keep going. Yeah. That's the time you need to feel yourself more. And you need to look in the mirror and you need to say, well, you know, and this will also sound cliche, but why am I doing this? You know, what is it that I want out of this? What am I hoping to do to better my life? And keep that goal in mind and let it motivate you with all the times that you don't want to do it, because that's the time you need to give yourself the biggest kick in the butt and move forward. You know, when I was working full-time at a job, there were times I'd, work, 90 hours a week. I'd get home at midnight and I could have easily made an excuse and said, well, I have to get up at 5. No excuse. Get to work. If I'm willing to do that for my job, why shouldn't I be willing to do that for myself? And always keep that mentality in mind and just push as far as you can.
If you really want to achieve something, you look at how you can fit it in your day. I know we all have the same 24 hours in the day, but, try to be creative in terms of if you have a W-2 job, work around, my typical work week. So I'll have my 40-hour work week. And then outside of those working hours, I start my next, 12 hours or 6-hour shift, if you will, of what I need to do. And so if you really want to succeed in this business, you have to find time. And like you said earlier, Charles, you said, don't stop, don't quit, don't find the perfect time to start. You just have to start and just keep going. You build momentum that way.
Yeah, I would say definitely so. So the gentleman that I wound up working for 14 years, ultimately, I probably never would have went down this path without working for him and working very closely with him and learning a lot from him. So I'd be remiss if I didn't mention him. He was somebody that was very influential, almost like a father figure to an extent. And I was fortunate that, I think he took a liking to me because I never complained about working long hours, never asked for extra money, which in retrospect, maybe I should have. I never complained. So because of that, I got to work very closely with him and to learn a lot. And it was a good foundation that has set me up for success in this business and also for other things in life. And on the real estate side, there's I'm sure plenty of other people I could name. One famous one that I'm sure many of us know, not personally, but at least know of, is Robert Kiyosaki. Like many others on here, I'm sure that a lot of us have read Rich Dad Poor Dad, and I'm the same. And I've probably read most of his other books as well. So I've always been a big fan of his keep it simple financial philosophy. And then aside from that, just people I've met in the syndication space over the last few years. For me, I'd taken some courses with Ari Mentor in 2017 and 18. So Dave Lindahl and his organization was definitely very helpful. People that I've met as sponsors and partners have also been very valuable too.
That's good. Now, do you still keep in touch with that investor that you worked with back in New York?
I do, yes, pretty regularly.
Have you invested with him or have you guys partnered up together?
No, so I don't think he would ever invest with us. And maybe at some point I would invest in the stuff he does, but he's more of a control freak. And truthfully, I'm a control freak too. So it may not always work well. And I would say that he's anything but passive, but he's a very good active investor. And that's what he likes. So I don't think he'd be the right fit for syndication. But if I get to the point where I'm buying some commercial deals on my own, then I think he'd be a wonderful person to partner with.
What projects are you guys currently working on right now?
Yeah. So One thing that we always like to do is to keep a pulse on the market, and we do that by looking at as many deals as we can. So, in March, we submitted 11 LOIs. I think we looked at something like maybe between 35 and 40 deals. And the goal is that you always want to be looking at deals. And you do it for a few reasons. One, to stay sharp, just so you're in tune with what's going on in the market. Two, so you stay relevant to brokers. So for most of us listening here, if you're looking at deals that are north of 50 units, you're probably going to wind up with, brokers bringing you the bulk of your deals. So it's important to let them know that you're staying active, so that way they'll keep sending you deals. And eventually, by submitting offers, you may even land something off market. So that's key. So that's really what I do to stay in touch. And then aside from that, I do listen to a couple of podcasts and also just read articles on a regular basis, because there's so much information that it's easy to have information overload now. So the key is to take enough information where you're armed and dangerous, and then be able to go out there and take action with it.
So with that, now that we're kind of hitting the tail end of COVID, what trends do you foresee, or what do you think might happen here by this year and next year for multifamily?
It's a great question. I could make an argument that the market is poised for growth and ready to explode. I could also make a similar argument that I think we're ready for a downturn. So what I would tell anybody at this point is to be prepared for both. I would continue buying, but definitely be cautious. The one thing I would say for multifamily specifically is I would expect it to go more up than down, with the only reason being that there's a lot of new money that's entered the space in the last year. So a lot of big time players, institutions, equity groups that don't normally get impacted whether you have a recession or not, have entered the multifamily space because they were traditionally buying traditional commercial, retail, office spaces that got hit very hard during the pandemic. And that's still fresh in a lot of their minds. So many of the people that went to those spaces for stability have exited those spaces and went to multifamily. So because of that, you're likely to see cap rates continue compressing and prices going higher because of all the new money that's in the space.
Mm-hmm. Are you guys looking at, or have you guys looked at other asset classes? Or are you guys specifically just multifamily at this point?
Right now, we're just multifamily, but I personally have interest in other asset classes. The gentleman that I used to work for focused more on like office and retail and industrial. So I've always had a liking for those assets. But right now on the syndication side, strictly multifamily, but down the line, we're always open to other possibilities also.
The reason why I say that is because a lot of folks are talking about these different asset classes to diversify your portfolio. Although we're vested in multifamily too, I was just curious to ask to see if that was something you guys would consider. So,
we would definitely consider it. What I like about multifamily, and I think this was evidenced throughout 2020 in the pandemic, is that it's a beacon of stability. Mm-hmm. And that's a plus. But the downside is everybody else has also realized that. And because of that, prices are through the roof at this point.
So what is one common myth about real estate investing that you want to debunk?
Okay, so one common myth I would say is that you need a lot of money to get started. Mm-hmm. Now, if you're using your own money, you're probably right. But one of the benefits is that you can use other people's money. And I often say syndication is probably the best legal way to use other people's money. So if you only have $50,000 or $100,000 and you want to invest in commercial real estate, you're probably not going to have a lot of success doing that on your own. But if you have that type of money and you want to be able to go out there and syndicate and raise money from other people, then all of a sudden you have a much larger buying power, and you're able to go out there and acquire commercial assets. So whether it's single family or multifamily or anything else in real estate, it does require money, but it doesn't have to be your money.
And right. For the longest time, from my perspective, I always thought you need deep pockets to be able to afford, these family properties and these mixed use real estate establishments. So.
I would agree with you. Even though syndication's been around for quite some time, it seems to have really exploded in the last 10 years and even more so in the last 5.
Yes, I did see that. Yeah, there was such a push here, even for the last 5 years or so. So how do you guys give back to the community?
So there's a few different ways. One is that I've always been a fan of teaching, but I'll save that for the end because that's going to be a free gift we're going to offer to all the listeners here today. But then another way is through different organizations and societies. For me, I'm part of my local Rotary Club. Rotary Club is a service-based organization, so we'll do things to help the local community. They range from cleaning streets to distributing medication to those in need, and also feeding the hungry. So I'll get involved with initiatives as I have time to from time to time. And then also, if I have the ability to help somebody along the way, sometimes just taking time out of your day and doing a nice gesture goes a long way.
But you enjoy, real estate.
Yeah.
So giving back to the community and then spending some more time in that space, I just think that just makes you such a more well-rounded person, I would say.
It gives you more perspective. It's in some ways it's good to realize that, listen, I'm not the richest person in the world. I'm not the poorest person. I'm somewhere in between. But things could be a lot worse.
Yeah.
So always keep that perspective and always be grateful for everything you have, even if it doesn't seem like much of the time. In most cases, it could always be worse.
From the way that you communicate to other people, it just transcends that way. So I think it's definitely a good attitude to have.
Yep.
So Charles, real quick, where can our listeners learn more and connect with you?
Absolutely. So they can reach me either by text 347-306-3278 or by email charles@threeoaksmanagement.com. That's the number 3 OAKSMGMT.com.
And our last question, it's sort of our signature question, if you will. It's a daily action that we'd like to tell to our listeners. So what actionable advice have you learned is the most important that a new investor should do or take as their next step towards their goals?
The single most important item I would tell anybody is building discipline in yourself and being consistent. And that's going to mean different things to different people because we're all in different situations. You may only have 30 minutes or 60 minutes a day to give. And some people may say, but that's not enough to do anything. So you need to start rewiring your mind and change your thinking and say, that is enough because that's all I have right now. And I can't give 4 or 5 hours a day. So what you have to do is just be consistent with that 30 minutes you have or that 60 minutes you have and do something to advance yourself forward. So when I was still working my full-time job, what I started doing is setting up appointments. Most times I didn't take a lunch break because it just wasn't what we were used to. I'm sure that we could have legally, but nobody at the company really did because we were used to just work. So as I started getting into syndication, I made it a priority to take some time. And depending on the day, some days it could only be 10 minutes. Some days it would be 20 minutes. Some days I would try and get out for 30. And what I would do is I would schedule phone calls in advance to use that time wisely. So that way there was no guesswork about me trying to call somebody and not being able to reach them at that time. I said, okay, this is all the time I have. I have to use it. I have to be smart and use it wisely. So I would schedule the appointment. I'd speak to a broker, speak to an attorney, speak to whoever you needed to, but do something each day to advance your business and make sure you're doing at least one thing. If you have more time, do more. But if all you can do is just a few minutes, then make sure you're consistent day in and day out. And eventually, even if it takes longer, what you'll realize is that effort starts to compound and you'll start to see some results.
So everyone, thank you for, the feedback. Really appreciate that, Charles. That was a lot of tidbits of valuable information. And for our folks out there, if you've stayed until the very end, as promised, we wanted to give you this free gift. And it's basically a free underwriting session that Charles does for free on Zoom every Saturday as a way of Charles giving back, which I think is just outstanding. Not only that, I've had the pleasure of actually sitting in on a few of these sessions that Charles actually conducts. And I think he does a tremendous job just going through the whole underwriting process and explaining and breaking things down to investors. As he alluded to earlier too, as well, deal flow, underwriting, and raising capital. If these are things that you can be efficient in, I think you'll definitely be well on your way to becoming a successful investor. And if you are interested in being a part of Charles's underwriting session, just send me an email at ernest@mvpequitygroup.com and tell Charles that you heard it on the Breakthrough Investor podcast. And Charles, do you have anything else that you would like to add?
No, it's been a pleasure being on the show today, Ernest, and I thank you so much for having me on.
It's a pleasure having you, Charles, and really appreciate you sharing your knowledge and your underwriting expertise. It was definitely helpful. All right, everyone, until the next time, take care. Thanks for listening to the Breakthrough Investor in Commercial Real Estate podcast. If you like what you heard and you found value in this episode, we would really appreciate if you would give us a rating and a review. And don't forget to subscribe so you don't miss the next episode. For those of you that are interested in investing passively in these types of deals in solid cash flowing commercial real estate throughout Arizona and Texas, as well as Idaho and Colorado, then visit us at mvpequitygroup.com. Fill out the investor interest form. That's mvpequitygroup.com. If you close on a multifamily deal or any other type of commercial property in the past 12 months and you want to be on this podcast, then send us an email on our Contact Us page for details. Thanks.